Continuing with our series, Economics 101, we now talk about the import price index. Now, it's not a widely covered number, but there's a very important reason we're going to show you why this could be one of the most significant economic reports to watch in 2025. The import price index, it measures the price changes of imports. It's used also to track the inflation rates. It was established at a level of 100 in the year 2000. When the price of imports rise, so does this index. Here we see the import price index over the past couple of years, starting at the beginning of the year at around 138, 139, leveling off now around 141. The import price index correlates very closely with inflation, logically, because it measures the price of goods that come in from overseas. In blue, that's the import price index. In red, PPI, the producer price index. And we can see over time they tend to move in the same direction. Now, the PPI, we wanted to include this in particular because that measures the cost of goods at the wholesale level. Includes imports as well as goods that are produced here. The import price index obviously only tackles imports, and that's why there's a close but not perfect correlation. Now, inflation surge of 2020, we've all felt this. Take a look at the import price index. In April of 2020, it was at 118, moving up to levels right where we stand right now, around 140. That's how significant of a change this inflation rate has been. In a recession, the demand for imports declines, and so does this index. This goes back to the year 2007. We can see during the strong markets of '07 and early '08, the import price index went from 113 up to 147. And then, after the financial crisis, as a result of that crisis, dropping all the way back down to 113. So we can begin to understand the range that this works in. Now, in terms of the import price index and the U.S. economy, a strong U.S. economy demands more goods as well, including imports, and prices tend to rise. A strong U.S. dollar weakens the import price index. Why? A strong US dollar can buy more goods that are priced in euros or Japanese yen, etc. Now, why is all this important now? Why are we talking about this? The import price index can be affected by trade policies like tariffs and trade agreements. And I'm sure everyone is very well aware that we're expecting to see tariffs in the next year. If that occurs, those tariffs could significantly increase the price on goods imported from overseas. Obviously, it's country specific, but be aware of this. Why? We should consider this when evaluating our investment decisions. If we're ready to invest in, let's say, a stock, and the stock derives of a majority of its business importing goods from overseas, such as Walmart, for example, that could significantly be affected. So we watch the import price index in order to evaluate whether Walmart, for example, might be a good investment. If it goes up, maybe not. Conversely, if we're looking at an investment that derives most of its business from domestic goods that are not imported, that might benefit from a tariff or trade agreement that is more favorable to domestically produced goods. So keep this in mind, and this import price index could really give us some sort of clue as far as which way certain stocks may move. As a reminder, this is all part of our long form series, Economics 101, where we talk about a number of different of the most significant economic numbers. Last time we spoke about the PPI, Producer Price Index. We hope this has been helpful. We look forward to seeing you back soon.